classify our costs, meaning we need to classify it as variable costs, fixed costs, as well as if we are presented with a mixed cost, that is a cost which includes a component of variable costing and a component of fixed cost, we are in a position to split it utilizing the available tools, which is either the high-low or regression analysis. These are the two most common approaches that we utilize to split it. Sometimes we also utilize inspection. And if you engaged with the webinar that was uploaded online, you would see all three approaches coming into being. For your prior learning, we uploaded one on regression analysis. And in the webinar question for this particular unit, there's a split using high-low and one utilizing an inspection or an inspection approach. Now, your variable cost at the end of the day will vary as your volume changes. Your semi-variable or mixed cost, there will be a component or a fixed element, and then there will be a variable component. This is the one that we end up generally splitting into high-low or utilizing high-low and regression analysis. When it's a semi-fixed cost, you would have seen it in that webinar example, green fingers, that Tutuka question on the webinar, where it was clearly by inspection, you had to find a relevant range. Within that range, you applied the high-low, but you would have found that your variable cost in that particular question was fixed in the sense that it didn't change, but your fixed cost changed as your volume changed, but it was constant within a particular range or a particular interval. And that was important for you to note in that particular webinar. Previously, I've spoken to you about the treatment of cost, product cost versus
Miriam.
Cost. Yes.
Would you mind putting your slides in presenter mode, because we actually can't read?
Sorry. It's the same slides that were uploaded for these topics. So, but nevertheless, Thank you so much for that. I'll put them in presenter mode now. Is this better?
Perfect.
Thank you. Right. So previously we have already looked at the treatment of our costs in terms of differentiating between product costs. Remember, product costs are inventoryable costs. We will find them on the face of our statement of financial position as inventory, and our period costs will be expensed in our profit and loss at the end of the period in which they were incurred. So it's important that we differentiate between product and period costs. We differentiate between that which is manufacturing costs and that which is non-manufacturing costs. It's also important for us to understand that those costs which are directly traceable to our cost objects and those which are indirect, because when we look at absorption costing, we will have to find a mechanism that will work for our environment in terms of assigning those costs, in whether we use arbitrary allocations utilizing the traditional approach, or we think about cause and effect allocation utilizing activity-based costing, which is going to come through in your Unit 8. We've already looked at the traditional costing when we looked at Unit 3. Now, our cost accumulation systems, which builds up to Unit 4, so we need to understand the difference between variable and absorption costing. And that differential is simply the treatment of that indirect cost. Those manufacturing costs which are indirect, how do we treat them? In variable costing, they become a period cost, and in absorption costing, they become a product cost. And then, of course, traditional versus activity-based costing is simply a mechanism that we utilize in terms of the allocation of those indirect costs at the end of the day. So it's important that you understand this very, very simply. And in summary, remember, At the beginning of the period, we come up with an allocation rate. We apply that rate to our actual production, and at the end of the period, we reconcile. And when we reconcile, we are interested in our expenditure variance and our volume variance. So both the expenditure variance and our volume variance will give rise to our over-under recovery, which we will then put into place on the face of our income statement under absorption costing. And you will see that in that unseen example this evening. Now, this is a good point for us to look at your tutorial set question called Perfect Pains. It was the 2007 ITC, a very old question. I'm just interested in this first particular part of the question, the A, whether you were in a position to split your costs into fixed and variable costs and come up with the product cost at the end of the day. I'm going to stop the screen, the slideshow, because I want to pick up the actual question or open up the actual question for you, which you would have already engaged in with your tutorial. I'm going to try and see if I can make this a little bit bigger. Okay, can you see this screen, people?
Mariam, why don't you minimize the sidebar? That's better.
Okay, I don't know how to. The problem is, the minute I use the dynamic zoom, it becomes a bit too big. I'm not going to be able to make it much bigger, but it's a question that you have in front of you, number one. And secondly, it's a question that you would have already engaged with in your tutorials. What I'm keen on is whether you arrived at the split of the cost, the manufacturing overheads into its variable and fixed components. And I'm going to leave the floor open. I'm going to request that you mute yourselves during the course of the presentation, but when it's question time like this, you unmute yourselves. So let's start off with, did you recognize that you had to work a little bit differently in this question? So firstly, can you give me a heads up whether you have attempted this question? This was last week's tutorial question from the early part of the week. There were 2 units to cover last week, Unit 3 and Unit 4. So this was the question from Unit 3, the tutorial set questions, which you would have completed last weekend. So remember, we're looking at a paint manufacturing environment. We're looking at batch production. We're looking at 2 types of paints being produced in the very same environment, which is Pro Touch and Best Guard. One has additives, extra labor. Machines need to be reset. There's setup costs. However, there's no differential in the cost of colorant. But this was very, very important that they provided us the budget for the year end, 29th of February 2008, where we were told the number of 20 liters of paint of Pro Touch and Best Guard being produced we told the cost of material, the cost of direct labor, the manufacturing overheads. And in terms of the overheads, we know that the overheads will have a component of fixed costs as well as a component of variable costs. And they inform us in the notes, manufacturing overheads include both fixed and variable costs. Variable manufacturing overheads have been allocated to ProTouch and Best Guard following a detailed analysis of production activities and related costs. The fixed overheads have been allocated based on the planned production. That means it has been allocated based on the number of units manufactured. And then they go on to inform us that if they were to produce 150,000 containers of ProTouch and 50,000 containers of Best Guard, the budgeted cost would be $88.75 and $140.75. So if they had to produce, so they inform us that if they had to produce 150,000 units of ProTouch and 50,000 units of Best Guard, then the manufacturing overheads will be a little different. It will be, let's just go back, it's $88.75 and $140.75. Right, and that was a useful piece of information for us. Right, now, what did you guys do at this point? Firstly, let me start off with, did you come up to a variable cost of 34 rands and a fixed cost of 73 rands for ProTouch?
This is America.
Did you arrive at that? I'm not seeing any comments coming through either, so I'm not sure. Can everyone see the slides now?
It's not really that legible, Mariam.
But the question was uploaded, and it was a tutorial question, Prof.
Yes, I know, but what you're writing on the screen is not that legible.
Oh, you mean this?
Yeah.
I've simply picked that up from this last so that we don't have to go back to this bottom part here. So I read the manufacturing overheads, and this is the part that I read, that 150,000 and 50,000 containers of Best Guard, the costing at this point. That's what I have reproduced here. So there's two types. There's ProTouch and there's Best Guard. Okay. If you look at the current they've got 100,000 units of ProTouch, and they've got 50,000 units of Best Guard. The total is 150,000 units. So we're looking at the units being produced. Now, they tell us that if they produce 150,000 and 50,000, there is a differential in cost. So, right, that's the first thing that you needed to recognize, that there's a difference in the volume. Now, when the manufacturing overheads, if it's 100,000,
Hi.
ProTouch total cost is 107.
Mama, how are you?
Best Guard's total cost is 159 per unit. So we could easily come up to a costing, a total costing for
Oh,
utilizing the 107 versus the 159. Okay, that's the first consideration. Just trying to make that.
Yeah, I'm in a meeting. I will call you later. I'll call you back later.
No, it's fine.
Sure, madam.
Right, it's a bit difficult without a board, but I just want you to understand. Now, when it's at this level, the cost is going to be slightly different. They're informing us that it is 88 Rand 75 and it's 140 Rands and 75. Now, immediately, you will be able to come up with a cost, with a total cost that is at the level of 150,000 units and a total cost at the level of 200,000 units. Do you agree? If you apply your high-low, approach, you have a difference in units. And that difference in units is equivalent to 50,000 units. Similarly, you will come up with a difference in the costs. And if you look at the difference in the costs, you will come up with 1,700,000. And if you divide that, you will come up with a cost. So before I forget, let me just give you the total cost at 150,000 units is given to us in the budget as 18,650,000 rands. Okay. If you look at the total cost at the level of 200,000, you will find that you had to compute it 150,000 times 88.75 plus 50,000 times 140.75. You will come up with 20,350,000. And that's the differential that I'm talking about here, that your difference in units is 50,000 and your difference is 20,350,000 minus 18,650,000. So applying that, you will get and if you divide it by 50,000, that's how you would have arrived at your costing of 34 rands per unit, which is equal to the variable cost per unit. Now, my question to you is, variable cost of which type of paint? Which type of paint? If you're looking at the difference in units and the difference in cost, which type of paint is this and why did I write there that it's of a specific type of paint? Anyone?
I see a hand up, Mariam.
Yes. Please, can you unmute yourself? Elizabeth? Elizabeth, are you with me? Please unmute yourself. Are you having a problem to unmute? Do you want to type up your question? It's Pro Touch. Yes. Why?
Because when you add the 34 and the 73, it ends up to the given cost of 107 of the Pro Touch.
But that had nothing to do with the 34 and the 73. We have solved for the 34 here. So if you've solved for the 34 by applying high-low, how do you know that that 34 rands per unit is the variable cost of Pro Touch? Very good, Rose. The volume only changed in Pro Touch. Well done. So if you look at this Nompumelelo, can you see there's 100,000 units of Pro Touch here. There's 150,000 units of Pro Touch. 50,000 Best Guard. So the number of units of Best Guard did not change. So the change in the price or in the total costs is only attributable to the one type of paint, which is the Pro Touch. And that 34 rands is therefore the variable cost per unit of the Pro Touch paint. Now, going there, that's when you can now solve for the fixed cost, which we know that the total cost is 107. If we subtract 34, that's how we come up to the 73 rands per unit of Pro Touch. That is the fixed cost of Pro Touch. Now, if you know that that is the fixed cost, now talk to me about Best Guard. What would be the variable cost of Best Guard? What is the fixed cost of Best Guard? Remember, the total cost of a unit of Best Guard is equal to 159 rands per unit. So Best Guard, the total cost is equal to 159. How would we come up with its variable cost? How would we come up with its fixed cost? What would you then do? Because if you looked at my computation here, you would notice that this high-low differential was only attributable to Pro Touch, and that's why that was the variable cost. Can the variable cost of Pro Touch be the same as Best Guard? That's what you need to be. That's what you need to consider based on the fact that they require more additives. They require more labor time. Can their variable cost of overheads be the same? That's your first question to yourself. And secondly, how will you
Dave?
then split your costs? What would you then deal with?
Inda. Ndamsendera.
Anyone?
But ndamsendera iri 1,850 because
Elizabeth, you have a hand up?
You can't get
Yes, Miss
smaller
Miriam.
functions
Don't
for
you then have a
capability and
look
budget.
at your change in costs? For example, you know your budget was 18
No,
18 million. Yeah, I think you look at your changes in
payment.
costs.
Okay, but
Yeah.
in this instance, it was just an understanding that the variable cost that we solved for was attributable to ProTouch. And by subtracting the variable cost, we came up to the fixed cost. And what would happen? Fixed cost by its nature of ProTouch will equal the fixed costs of Best Guard. So in this instance, it was your fixed cost that would remain constant per unit, and you would then solve for your variable cost of Best Guard by subtracting the fixed cost from the total cost, and you would have come up to a different value, and that would give you what would be 86 rands. Yes, correct. Did you understand where this question was heading? This basically was an application of Unit 3, high-low, but not the norm that you would have gone backwards and just solved for the fixed cost. Here you had to consider the fact that there's a difference in the unit of only one type of product, so that variable cost was not common to both products. It was only the variable cost of the one product, ProTouch. You then had to solve for its fixed cost, and from there you had to move backwards. And that's where the question that I said you need to look at was the 7-mark question for this evening. Calculate the total fixed manufacturing overhead cost and the variable manufacturing overhead cost per container of ProTouch and Best Guard paint in the budget of Perfect Paints. Did anyone come up to the right solution? Anyone? I'm going to say you must revisit this question when you deal with Unit 8, which is ABC. You must look at that part. When you look at Unit 6, which is relevant costing, you can look at these two questions. So revisit this particular question next week when you deal with Unit 6, and 2 weeks down the line when you deal with Unit 8. So in terms of Unit 3, I wanted to introduce the question to you, but specifically only for the A part, because I wanted you to start thinking a little bit more carefully in terms of the presentation of the material. And if you went online and engaged with the pre-recorded webinar, you would have seen the different ways in which you could split your costs utilizing the high, low, etc., and inspection approaches. Now, are there any questions on this particular concept before we wrap up Unit 3? And Unit 4 and 5 will deal with it cumulatively. Any queries on this question? Someone's on the chat. Fixed cost is the same and the variable cost will be 86. Yes, Rose. Absolutely correct. Any other questions? No. Okay, then let's close up this and we will Okay, moving on. Let's continue. Some problem with these. Right. So it was the A part that I wanted to look out for, which is the total fixed manufacturing overheads and the variable manufacturing overheads. Right. In absorption variable costing, someone's asked for the document. Which document are you referring to? The question.
The workings.
The workings. Okay, I do have it with the workings. It might not be the one that didn't say, but the workings are on there. It was just written small, and that's when I added the note to enlarge it. So either way, the workings will be there. Okay, right. So moving on, we're looking at an overview, a quick overview of absorption variable costing and CVP, which goes hand in hand. So remember, it's important for you to understand the layout of a statement of comprehensive income under variable costing and the layout under absorption costing. It is very, very important that you understand that. It is from your undergraduate, from your second year management, accounting and finance that you deal with that. You also need to understand what goes into an absorption costing statement, what goes into a variable costing statement. You also need to understand the approaches to inventory valuation, especially FIFO versus weighted average. Generally, your question will guide you. And in the absence of it, we can always assume FIFO will be applicable. From the prior learning, you need to revise the principles of process costing and joint and byproduct costing when you're dealing with Unit 4. It's not that it is going to come into absorption or variable costing, but it is an expectation that you are carrying forward this knowledge, because with process costing comes the principle of loss that you may have to build into your computations. And then, of course, your joint and byproduct costing will impact going forward into your Unit 6, which is your relevant costing in terms of should you process further, should you add a product line, etc. And these are the considerations that you need to note. Right. Now, once again, absorption costing, we are following our system for IAS2 for external reporting and production of financial statements. We need to understand the full cost. Remember, IAS2, all costs incurred in bringing a good or service to its present location in its current form, in a saleable form, and that's what we want to look out for, all the costs that are incurred. We will look at our variances, both volume and expenditure variance, which will give rise to our over-under recovery. We allocate our variable and fixed manufacturing costs to inventory, meaning the cost of our product, and we'll indicate gross profit. Under variable costing, it's for management decision-making mainly, and it is very, very important to us in math that we understand this for purposes of not only the production of a variable costing statement, but for looking at the principles of relevant costing when we look at it from the perspective of transfer pricing, as well as when we compute some variances. There's some variances that won't be applicable if we are dealing with variable costing, for example, fixed manufacturing, overhead, volume variance. We will not compute under a variable costing system. So it's important that you recognize these differences. I'm not going to go through the simple product example. It was already sitting in your slides. I just brought it up just to highlight the difference in your statements. So just to go back, remember your variable costing statement, you will refer to it as contribution, marginal income. Your fixed manufacturing overheads is a period cost, which is cast off as an expense in this in the income statement in this particular period. In absorption costing, the fixed manufacturing overhead is allocated. And because it is allocated, it will not equate the actual expenditure. And that's when we have to come up with our expenditure variance and our volume variance based on if we have absorbed more or less overheads when we applied the allocated rate to our actual production. Remember the end of Unit 3 slide that we look at computing at the beginning of a period using our budgeted cost and our normal capacity, and we come up with an allocated rate. During our production process, we apply that rate to our actual production. At the end of the period, we then reconcile. And then we also need to look at our different methods of stock valuation. Remember, weighted average versus FIFO. And we need to remember, if we are not given any indication, FIFO can generally be applied if the question is silent, but you can easily test it, and you will see that in this question that we are going to look out for. A quick rundown of process costing. Remember to differentiate between normal versus abnormal losses, because normal loss becomes part of the product cost, abnormal loss becomes a period cost, which is expensed at the end of the day. And in terms of joint and byproduct costing, remember our joint costs are allocated to our normal products. We do not allocate joint costs to byproduct unless a particular environment warrants that allocation, and you are informed explicitly about that. And then that leads to our CVP. Just revise your basic formulae from your undergraduate. Think about the break-even point and think about the consideration of the margin of safety. But most importantly, like today's example, you will see that we have multiple products. So when you produce 2 or more products, then that break-even or the break-even point becomes important for you to be in a position to compute. And of course, sensitivity analysis, where you assume that your profit is equal to 0. You manipulate one variable at a time to identify what fluctuations you can absorb in your environment without going into the realm of loss. So your basic formula is where your profit is the number of units sold multiplied by the selling price, less the cost, less the fixed cost. So your variable cost, less your fixed cost, that's your ultimate profit. But in variable costing, we are interested in contribution, which is the selling price less all our variable costs. And that becomes an important consideration for us. We also think about contribution ratios, which is the contribution over the sales value, because our break-even point, we are interested in our total fixed cost over our contribution per unit. Remember, sometimes you have fixed income, and that fixed income reduces. So when you think about the fixed cost, it is total fixed cost less any fixed income divided by your contribution per unit. Later on, when we deal with the unit on standard costing, you will find that unit on standard costing, you will look at a question, and it's called Aero Africa. It's an ITC question. And you will see very often that sometimes you have certain, in certain environments, there is an element of fixed cost that you will have to reduce your fixed income that will reduce your fixed cost before you compute your break-even point. Okay. And always round up your answers, because with break-even, remember, one less unit, if you round down, you are going to fall short in recouping your fixed costs. I'm not going to go through too much of this because I think you are familiar with this from undergraduate. But what I would just like to point out is that when you're dealing with a multiple product, so you can take a total fixed cost and you can divide it by your weighted average contribution per unit, or you can come up with your combined contribution percentage or contribution ratio, and that can also determine your break-even point. But now to compute those weighted average contribution, you must use the constant sales mix. So the mix, the relationship of each product that you are dealing with. So it's very, very important that you look at your budgeted sales mix, and utilizing that budgeted sales mix, you will compute your weighted average contribution. Now, with sensitivity, we are looking at the changes, like I said, the fluctuations that an enterprise can absorb without moving into the realm of loss. That means they break even. So at any point, you can let your profit equal zero, and the unknown variable that you want to look at the change in, you can allow that to be the X, the unknown, and you can solve based on that. Now, in this question, Pearly Jewels, there's a nice question that requires you to calculate the budgeted break-even point for a multi-product, as well as preparing an income statement on an absorption costing basis. Okay, so once more, I am going to come out of the slideshow and I'm going to open up the document that I sent to you this afternoon. So in terms of an overview, I just wanted to present a very, very simplistic overview, because I would have assumed that you would have already engaged with the material of units 3 to 5, and you would have at this particular point in time, you would be engaging in the last bit of right. Okay, so I'm hoping that this is visible to you. It's a very, very short question. Okay, there's hardly any read. It should not take you more than 5 minutes to read it and 5 minutes to process it, and then we can engage in a discussion. So I'm going to give you, it's 19:53. I'm going to give you 7 minutes to read this question, or if you've already read it, to process it. Because there's hardly any read. And we're going to look at A and B. I think it is recording. I must admit, I completely forgot to check whether it's recording or not. It is recording. So to answer your question, it is recording, but I'm not sure how competent the recording is, and that's why we encourage you to join online. So I'm going to give you all 7 minutes, and then we'll have a healthy discussion on this. We may just go a little bit over time if you haven't engaged with it. Okay, so I got a heads up that we're ready. It's exactly 8 o'clock. Your 7 minutes are up. Right, let's get going. Okay, first and foremost, let's start looking at this question. Carla Pruni is the management accountant of Pearly Jewels Limited. She has extracted the following information for the period ending 28th of March 2009. Now, the first line item, units sold. How is this information going to be useful for you? Please unmute yourselves for this part of the session.
To calculate your units produced in the period, I think.
Apart from that, what would this part be useful for? Units sold. It's budgeted information. So this is giving you your budgeted sales, right? And how will budgeted sales help you out?
For the product
How will
mix.
Yes, your sales mix. It will help you out in the sales mix. And from the previous slide, where does the sales mix, or how will the sales mix be useful to you? It will be useful to you in computing what?
The
Break-even point.
Contribution.
break-even point.
Yes, the weighted
Average.
average contribution. Okay, well done. Right, now we have our budgeted selling price. So this is our selling price. We have our variable manufacturing costs. We also have our packaging cost, which is also a form of variable cost. And what do you note? These are in rands, and all of a sudden, what happens here?
Percentage.
Percentage.
It's a percentage.
So this means you will have to compute 4% of 500 rands, and you've got to compute 8% of 1,200 rands. So if you compute the 4%, what do you get? 4 5s are
20 rands.
20, yes. And you're going to get 8% of 1,200 rands. What will you get?
96 rand.
90 rands. So now you have another component of what? Of variable cost. And where we are headed is our selling price less our variable cost will give rise to our contribution. And from there, using the sales mix, we will be in a position to come up with our weighted average contribution. But we can't come up with the contribution yet because we still need to identify if there are other elements of variable costs. And are there any other elements? That's what we need to look out for. And then when you move on to your read, what do you see? That there are a set of costs that are provided to us, which is given to us as both fixed and variable. Now, immediately when you read the word salaries, what went through your mind? What type of cost?
It's fixed.
Fixed costs. Okay. Now, when you look at freight and duty, we can't make that call until we read notes 3, 4, 5, and 6 for the rest of it. So we will then read the notes and come back and revisit that. Okay. Now, Ms. Pruny prepared the following income statement. What is she telling us? How did she prepare it?
On a variable costing system.
Direct costing, which is variable.
So basically, when we look at opening inventory, production, and closing inventory, what type of cost, what type of product cost would you see here?
Product cost.
What type of cost?
Fixed and variable.
It's variable.
Variable cost. So immediately now, if you go below and you look at the quantity schedule, now this is providing us the actual information. Now, if it provides us the actual information, we have the sales, we have the opening inventory. What can we compute? What are we in a position to compute now?
Production.
The
Production. So our production will be what? Our sales So if we take our sales, we add our closing stock, and we subtract our opening stock, we'll be in a position to come up with our cost, our number of units of production at the end of the day. So 19 plus 2.5 plus 1.5, what are you going to get here? 20,000. You can double check that. 3 plus 8 minus 6, we've got production units. Now let's go back. We know that this is the variable product cost. Opening inventory is valued at 165,000. But how many units is opening inventory? 1,500. So if you take this and if you divide it by 1,500, you will come up with the variable cost of opening inventory. If you take the 2.4 and if you divide it by 20,000 units, you will come up with and this is easy, 2.4 million over 20,000. This is an easy computation. You don't need a calculator, 120 rands. Now, if you took the closing inventory, which was 2,500 units, and you took this 300,000 and divided by 2,500, you will notice that it is 120 rands per unit. Now, if the cost of production equals the value of closing inventory, and if you took the 165,000 rands and divided it by 1,500, what would you get? 110 rands. Can you see the variable cost of opening inventory differs from production and closing inventory? The fact that these two are the same, you know that this environment is using what? FIFO. Remember? Earlier on, we spoke about the different ways to value inventory. So from this, you can see that Ms. Pruny is using FIFO, and you are in a position to already come up with the variable cost of production. You've come up with your production number of units. Now, looking at the read, which shouldn't have taken you more than 5 minutes, no material inventory of imported raw materials or work in process are held. So that means we don't have any opening stock of raw material or closing stock or even of unfinished goods. So the only inventory that we have is of finished goods. So this is only finished goods inventory. And the variable manufacturing cost consists of raw material, variable overheads. Raw materials are paid for in US dollars. Inventory is imported on an as required basis, and freight and duty are paid on the value of raw materials. So that implies that the freight and duty is a variable cost. So sitting in that variable cost, it's basically raw materials and variable. There is, immediately you see, there's no labor in the variable cost in this particular environment. So if you go back, immediately you can see that the manufacturing labor is going to be treated as a fixed cost, and your freight and duty is going to be a variable cost because it is aligned to the raw material, and that raw material is all consumed in the production of the product. There is no opening stock or closing stock of raw material. Now, when you look at manufacturing labor and overhead, they tell us to read notes 4 and 5. So let's read notes 4 and 5. Pearly Jewels has a normal capacity of 114,000 labor hours. used to determine the fixed manufacturing overhead rate. Now remember from Unit 3, we did this at the last lesson as well. Today we just focused on high, low, and the splitting of the cost. But at the last session, we spoke about how we need to learn to allocate or come up with the allocation rate, where we end up using the normal capacity and we use a volume basis. In this instance, they're telling us that it's labor hours used to determine the fixed manufacturing overhead rate. And then it is, for a particular period, the budgeted for shiny and glitter. So we have shiny, and the budgeted hours for shiny is 80,000 hours. The budgeted for glitter is 22,400 hours. Okay? And budgeted manufacturing overheads increased from 2,622,000 the previous year to the current amount. So remember, this is providing us with 2009. So if we went to 2008, then the budgeted overheads here were 2 million. So they're informing us very importantly in this, and that's why you need to read very carefully that the overheads were 2,622,000 in 2008. It differs from the 2009 period. Okay? And then when they speak about labor, no difference. It is the same in 2008 as well as 2009. In terms of note number 6, the sales and distribution costs, we told that 20% is a variable cost. So that implies that 80% is going to be fixed. So we know the element or the split between the variable and the fixed component of these costs. We also know what the cost was so that we can determine the overheads in the 2008 period versus the 2009 period. But to complete the read, actual costs approximate budgeted costs. So in these budgeted costs, the information is that the actual equals.
No, nothing. Pane, just to check
Someone
later.
got the.
Pane,
Can you please unmute yourself, young man?
in the account here.
Samson, can you please unmute yourself? You're distracting the class.
Oh shit! What am I doing?
Sorry, mute yourself. So the actual cost equals budgeted. So all these costs that you see here, because we haven't been advised otherwise, the actual cost will approximate the budgeted cost. And then this part of the read is building up to an ABC system, which we are not looking at tonight. Now, Ms. Pruny prepared an income statement under variable costing. She's given us all the information. We have the budgeted. We know that this 80,000 hours is producing 20,000 units, which implies 4 hours per unit. We know this 22,400 is going to produce 3,200 units. So it's going to consume, I think, 3,2 into 22, 7 hours. 7 hours per unit. Okay. Now, based on this information, based on the fact that we have normal capacity, 114,000 labor hours. Can you see we can go here and we can compute allocation rates. It's very easy to compute allocation rates for manufacturing, labor, etc. What would be the allocation rates? We will take the budgeted costs and we will divide it by our normal capacity. Can you see revising the element of Unit 3? Now, in this instance, labor is also treated as fixed cost. And if you engaged with your slides online and your unit guide, you would have read that paragraph under fixed costs where we said that if labor is treated as a fixed cost, then sometimes we may need to, under absorption costing, just like how we allocate manufacturing overheads to a product cost, we will have to take the cost of that fixed manufacturing labor and allocate it to the product cost. And in moving from a variable costing statement, when you move from a variable costing statement to an absorption costing statement, you have to guard for the difference in product costs that arise. And that's where this entire question was sitting. The first part of the read built out to your break even. You can see the split of your cost. You know exactly what element is fixed cost, what amounts are fixed costs, what amounts are variable costs. And now look at the question. Prepare the income statement on the absorption costing basis and calculate the budgeted break-even point. They're requiring us to compute the budgeted break-even point. And to come up with the budgeted break-even point, it's our total fixed cost divided by our weighted average contribution. And from there, you will come up with a budgeted point for shiny and a budgeted point for glitter, the two products. Now, what would be your starting point now that I have actually taken you through the steps and assisted you in breaking up the question? Where would you start now in answering this question to earn the 26 marks if this was your test? Would the sales value change between absorption and variable costing?
No, it doesn't change.
So this line item could have been carried through without any issues. Agreed. Stays the same. Okay. Now, when we're dealing with the move between variable costing to absorption costing, what has to change now? We have to think about the change that's going to be sitting here. This is going to come from 2008. These costs are going to come from 2009, and that cost is going to come from 2009 because we've established that it's a FIFO system. So we know the variable cost of production, meaning the cost of raw material, variable manufacturing overheads, as well as the freight. We don't need to reinvent the wheel. We just have to take these values, divide by the production and the opening stock quantity using this quantity schedule, and we come up with the variable cost. But to arrive at the total cost required for absorption costing, we will then need to make sure that we apply our allocation rates. And this is where the allocation rates come into being, where we have to take this and divide by our normal capacity. Take this value and divide by our normal capacity to come up with allocation rates. Only if we come up with the appropriate allocation rate can then apply it to production. And what else should we? So if we apply this rate, so if we take our budgeted costs and we divide it by normal capacity, we will come up with our allocation rate. We will come up with allocation rate for 2008. We will come up with an allocation rate for 2009. You will find that to deal with it for manufacturing overheads, and we will have to look at fixed manufacturing labor as well. Right. Now, if you came up with, if you have a calculator in front of you, take the value, take 2,622,000 and divide it by 114,000. What do you get for manufacturing overhead? 23 rands?
Yes.
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 And if you take the 2.850, what will you get? 25.
24.
You are going to apply it to shiny. You're going to apply it to glitter. Remember that. Okay? If you took the fixed labor, it's going to be the same. You will get 30 rands. Both periods, it's going to be 30 rands. But remember, the budget is 4 hours for a shiny and 6 hours for a glitter. So I'm just going to put there 2008 and 2009. And we will deal with the manufacturing overheads because it differs. So it's 23 rands times 4 versus 25 rands times 4. So it's 100 rands. And here it's going to be 92 rands. That's your allocation rate. The 25 rands times 7 is going to give you 175 rands, and 23 rands times 7, what's that going to give you?
161.
161. Okay. Now, for labor, it's consistent 4 hours times 30, which is 120 rands. And for glitter, 30 times 7, which is 210 rands. Remember, 2008 is going to equal, just going to bring that down in line with labor. Right. It's going to be the same for shiny, and it's going to be the same for glitter. So just a note, 2008 equals 2009. Now, I'm just writing here because it's easy for the product cost. So if I look at 2008, if I look at shiny versus glitter, right? I've got the variable cost from the income statement, okay? And the income statement is 110 rands. And if you look at the income statement, take your calculators, people, go to the given income statement. You will take the 174,000 and divide it by 600 units. And what do you get for opening stock, the variable cost? You get 290 rands for glitter?
290.
Yes, 290. Now you've got fixed manufacturing overheads and you've got fixed labor costs. So the fixed manufacturing overheads, it's 92 rands for shiny and it's 161 rands for glitter. Labor, it's 120 rands and it's 210 rands. So now you can now come up to the cost per unit of opening stock. Because only if you get this right will you be in a position to move ahead. So you should have gotten 322 rands versus 661 rand. And you do the same thing for 2009. I'm going to give you 2 minutes to come up with a value for 2009. Since we've done these values, I'm just going to transcribe them for you. And you give me a value there. What's your variable cost for 2009? Anyone, what did you get? 120. Yes, well done, Rose. And for glitter? What do you get for the variable cost of glitter? It take you 1 minute. From the income statement, all you're doing is taking the cost and dividing it by the number of units produced. You should have gotten 324 rands. And you should arrive at a total cost of 709. Right. Having said that now, and I'm just going down because I need some space. The next consideration for you is to determine your allocation. Okay? So you know that we have shiny and we have glitter. Okay? We have an allocation rate. So fixed manufacturing overheads, your allocation rate for shiny based on the computation that we did here. Remember? Okay, so it's very important that you understand where we are headed with this. So we are building up to an understanding of our over-under recovery, right? So you know that if you can deal with this cumulatively, fixed manufacturing overheads plus your fixed labor. And what is the cost for Shiny? In 2009, it's 120 plus 100 rands. And for glitter, it's 210 rands for the labor, plus it's 175. So we're looking at 220 rands to be applied, and we're looking at 385 rands per unit to be applied. Now, how many units did we produce? So what is our actual production? And our actual production of Shiny is 20,000 units, and of glitter, it's 3,200 units. So now I want you to multiply this. So if you take 220 times 20,000 units, what will you get? 4 million?
4.4 million.
Okay. 3,200 times 385?
1,232,000.
Right. Now, if you add this up cumulatively, this is going to give you 5,632,000. This is our applied, or that which we absorbed, okay, in terms of our overheads. Now, if we've got 5,632,000, okay, what was our actual overheads going back? So this, I'm just going to write the word applied. Now, our actual, we have been provided in our question. We know that in 2009, for labor, it was 3,420,000. For our manufacturing overheads, it was 2,850,000. And this total now comes up to 6,270,000. And you see the actual is 6,270,000. The applied is 5,632,000. So this difference that you see now, what is this difference? What is this difference?
Over applied.
It's over applied or under applied. We have applied 5 million.
Oh, it's
Our actual overheads are more than
applied.
It's an under recovery. Can you see the difference? And now once you've gotten this over under recovery, remember they said actual cost approximates budgeted cost. So therefore there will be no expenditure variance. The variance that arose here is due to the fact that we may have budgeted to produce more or less, or we may have budgeted to produce more units and we actually produce less. Therefore, we have absorbed less and we have an under recovery. Now, based on this, the income statement becomes very easy because you've got your over under recovery, you've got your cost per unit, and you are now in a position and you know what the other costs are. You know exactly what the sales and distribution costs. You know the rest of your costs. You can now put together your income statement. Your sales is exactly as per given, no difference from her computation. You needed the 322 and the 661. to come up with the value of opening stock, because this value now, what is the difference between this and Carla pruning? What does it include? It includes fixed manufacturing overheads and what else? Our fixed labor costs. Similarly to production and to closing inventory, we needed to arrive at the 340. We needed to arrive at the 340 and the 709. Once we got there, you would have come up to your gross profit. You needed to come up with your over-under recovery, to come up with your adjusted profit, and then your normal non-manufacturing costs for absorption costing, which is your 4% and your 8% that we had highlighted, your variable and fixed actual costs, your admin salaries that we've recognized, non-manufacturing, and you come up with your net profit, and you would have earned your 26 marks. But the majority of the marks would have been sitting in coming up with the computation, looking at the allocation, coming up with the allocation rates, differentiating between 2008 for opening stock and 2009 for current production, allocating it, coming up with the cost per unit in 2008, coming up with a cost per unit in 2009. And then the second question was super easy because we already saw the sales mix. We looked at the selling price, no less our variable costs, and we have our budgeted fixed cost, which is admin salaries. Remember, only 80% for sales and distribution. And once you've got your total fixed cost, you needed your contribution. We got the 120 and the 324 from our production. We didn't need to split it. It was this in gray is not required. Our division was straightforward, but our selling price, we know our sales commission, and we know our variable, the 20% of our variable costs, we needed to allocate it to the budgeted number of units. And then what must we do at this point? What do we need to apply at this point? This is where we needed to apply what? Our sales mix and come up with the weighted average contribution. That's what we needed to arrive at. Alternatively, you could have taken the total budgeted sales, could have taken the total budgeted contribution, and you can come up with a contribution ratio. And if you take your fixed costs and you divide your fixed costs by your contribution ratio, you will come up with your break-even point in rand terms. So this was a simple question, but its basis was on foundational knowledge, understanding the difference between product costs and period costs, variable costing system and absorption costing system, and looking at how to allocate your fixed costs in this particular environment. And that's how you would have computed, or you could have dealt with the sales mix, like I had spoken to you about, the 18,000 and the 6,000, come up with a weighted average contribution. You will come up with exactly, you should end up with exactly the same answer. There was a slight rounding differential, but you can work around that. Okay, and I know I've overstepped my time, but I wanted to use this to revise the principles using a question that you have not engaged in. So I didn't want to go through another tough question, but now I'm happy to address any questions that you may have on this particular question or any of your other questions in units 3, 4, and 5. Any questions, anyone? Did you find this question valuable?
Yes,
Do you,
Mariam.
do you like the fact that we use an unseen question, or would you prefer the next lesson to use one of your tutorial questions that's already been set?
Unseen is better.
I think the answer is
Unseen question.
Unseen one.
Unseen, please. It forces us to think on the feet.
Thank you. Okay, so then I will find another unseen question for the next session. The next session, I plan on looking at Unit 6, 7, and maybe a bit of Unit 8. And what I don't cover in the next session, our workshop will cover with our with some test prep questions at the workshop. We will cover those particular concepts in that last session. So the next session, I'm hoping Unit 6, 7, and 8, an overview, and then the last Unit 9 at the workshop. Any questions, anyone? I didn't see many questions coming through. Last week, or the last lesson, you all had lots of questions. You all raised quite a lot of questions, but this time I noticed everyone was a little bit quiet.
It's getting hectic.
Okay.
I think
So
side,
this weekend, you would now engage in the rest of your tutorials on Unit 5, which is CVP. And then next week will be the principles of relevant costing.
Mm-hmm.
Okay, if you don't have any further questions, then I'd like to thank you very much for attending. I do appreciate your attendance. It's just a pity that we only have like a third of your class attending, but you are the converted and you are here. I do hope that it benefits you. I'd like you to pop me a mail if you're happy with the way in which I'm running these sessions, and if you would like anything changed. I know that some of you use the Moodle platform for questions as well. That's also fine. You can either chat to me via the Moodle or with an email. If you chat via the Moodle, then I think everyone's privy to the question and my response is visible to all. So that will be, I think, a better mode of communication. Like we had the question, in terms of the clarity of the tutorial submission date and stuff like that. So please feel free to contact us, and please raise your questions and queries. I do understand it's early days, but we're already on Unit 5, and then we have Unit 6, 7, 8, and 9 to go, and then that will just build you or lead you into your test 1. And I don't want you floundering with test 1. Raise your questions as we work through the units. I'm also trying my best to break it up as equitably as possible over the sessions. Right. Thank you all. Have a good evening and study hard.
Mariam, can I just have a chat?
Sure. I see a hand raised. Leashlet, do you have a hand up? No. Prof, can you go ahead and say what you
Sorry,
needed to say to the students?
I just wanted to chat to you afterwards.
Oh, okay, no problem. No problem. I thought it was with the students.
Sorry.
Okay.
Sorry, ma'am.
Yes.
I don't know if anyone else is experiencing this problem, but I'm unable to open the presentations uploaded on the Moodle.
You're unable to open. Now, if you look at math, there's one that says SCORM, and there's one that doesn't. You need to go to the one that doesn't say SCORM. I think that's the one that opens up. So, for example, I'm just going to quickly try and go online whilst you're here so we can double check. But that's what Wasim had told me. Someone had raised the similar query a while back. And so we'll just go to any unit. Let's go to unit 1. So you see this one that says COM, but I see that's hidden from students. So if you go to presentation 1, so immediately you click on it, it downloads. And then you open the download. Did you notice that, Kolya?
Sorry, ma'am, I'm just trying to check for myself here. So when I
you see what I did, okay? So I'll come out of this again. Right. So I'll go to a unit.
Mm-hmm.
Oops, what's happened here? Right. So let me go to unit 2, for example. Right. So I'll go to presentation unit 2. Let me just go to unit 2. Right. So when I go to unit 2, I just go to presentation, right? And I click on it. Do you see automatically it downloads? It doesn't open up online. For some reason, it downloads, right? Once it downloads, then I have to open it from the download.
Yeah, it
There
seems to
seems to
be
be a
working on
glitch on the
your computer
system.
only.
For some reason, it doesn't allow. I'm using a Mac and it does that for me.
Yeah, for us it's not. I even tried to look for an app that can open that or convert it to a PowerPoint. It didn't work. Even up to now, I haven't been able to.
Well, you know what I can do to help you guys out until they resolve it, but I can send them as an attachment to you via the announcement.
Oh, that
would that
awesome.
help you?
I think that
Yes,
would be far
please.
much better.
So what I'll do, it'll be because they're very big files. I will probably have to break it up into a couple of announcements. Right? I will do that early tomorrow. I will send you unit 1, 2, 3, 4, and 5 because that's where you're up to at this point, and that should help you out.
Thank you very much.
Okay,
and then I
thank
will
you.
raise that with Wasim to resolve that issue.
Thank you very much.
Thank you, ma'am.
Okay, thank you, guys. Nick, I'm going to come out of this and then exit and then rejoin if you don't mind.
Yeah, that's fine. Absolutely fine.
Oh, okay. Bye.
Okay. Bye, everyone.